Hello everyone, welcome to today's video. In today's video, we're going to learn about options, right? So, so what are options? So let us first start with the definition, and then we can start with the types of options and what is a call option, what's a put option. We're going to talk about all of that in today's video. So we are going to start with something called as derivatives. Okay, so basically, you must have heard of this word in like differentiations and all derivatives, but this is not necessarily that. But the word generally means the derivative is an instrument. It's an instrument that derives its value from an underlying asset, right? It's an instrument that derives its value from an underlying asset. From an underlying asset. So first of all, let us unpack this statement and then let's try to understand what does derivative mean. For example, let me say that there is a gold derivative, right? For this example, let's take a gold derivative. And this gold derivative derives its values from what? It derives its value from the value of gold. From the value of gold, right? So a gold derivative can be used if you think that the gold value will be going up in the future, then you're betting that the gold value will increase. So as this value increases, the value of your gold derivative also increases. It's as simple as that, right? There can be an opposite kind of like scenario as well, where you have a gold derivative and the gold derivative uh, decreases in value, or when the underlying asset, which is the gold, increases in value. So this is an inverse correlation in here. This is an inverse correlation, and this here is a positive correlation, right? It's as simple as that. Now let us kind of like try to understand what are options. Now there are different kinds of derivatives, the different kinds of derivatives available in the market. So let us basically try to see what are the different kinds of derivatives, right? So derivatives, there are four derivatives: forwards, futures, swaps, and options. Now when we're discussing derivatives, you are typically discussing about derivatives on the stock market that are listed on an exchange. Okay, so only futures and options are traded on the exchange. Forwards and swaps are not traded on an exchange. So for this video and for all the other parts that we're going to discuss in the remaining videos, we are not going to be concern ourselves with forwards and swaps. We don't really need them, right? Because only futures and options are traded on an exchange. Futures and options are traded on an exchange. Okay. So let us briefly try to understand what is an options. In another video, maybe I will try to cover futures as well. But for today's video, I think we'll just cover options. So now let us kind of like have a definition for options. Options is a derivatives contract. A derivatives contract that gives the right but not obligation to buy or sell asset an asset. Okay, so let us quickly unpack this argument. So what I'm saying is that options are derivatives, right? the same thing, derivatives or derivatives contract. It gives you the right but not the obligation. That means you have the right to exercise the contract if you want to on the expiry date. Okay, so you can buy or sell the asset based on how your option bet took place. So basically, it is a derivatives contract that derives that gives the investor the right but not the obligations. That means I can either exercise my option, or I can choose to not exercise my option. So let us quickly decimate what are the different kinds of options available. So, to be put normally, options are of two types. You have call option and you have a put option, right? And for any options, you need to have a buyer and you need to have a seller. So, there are call buyers, and you will also have call seller. In the similar way, you will have a put buyer and you will also have a put seller, right? So when you're basically buying call options, what are you doing? So let us kind of like quickly understand who is a call buyer. So call buyer is somebody who believes that maybe 1 month from now, maybe 2 months from now, or 3 months from now, depending upon the expiry date, he believes that the market will go up. So he is a bullish buyer, right? He's a bullish person. He believes that the market 1 month from now will be on a bull run. It will be on a bull rally. That means the price of the underlying asset will increase. And he wants. So, what is the basic psychology of a call buyer? Basically, suppose Reliance currently trades at 2100. It's not an actual price. I'm just saying it for an example. Now, in the future, you believe that Reliance would be trading at 2300. Now, would you benefit if you are able to buy this 2300 worth Reliance 1 month from now at only 2100? Obviously. I mean, you wanted to buy Reliance shares, but at what price you want to buy it? You want to buy it at 2100. But if the price increases, right? I mean, you're somebody who expects that the market is going really well, so you don't want to, what do you have to do? You are basically want to buy Reliance at 2100, but currently the market price is 2100, and in the future it will become 2300. This is basically what you expect. So this 2300, where you're expecting your Reliance to land on 1 month later, is called as a strike price. It is the price at which you want to exercise your option. That means you want to have the right to buy the Reliance at 2100, when 1 month from now it is going to trade at 2300, right? Let me go down maybe, or we can just go to a new we can just basically go to a new board. So you have a call buyer. So what did I say a call buyer is? A call buyer is somebody who believes that the asset will go up in value in the future. It can be 1 month from now, 2 months from now, 3 months from now. Okay. So this is like and forward looking betting. Like you're betting that the market will go up. So when I'm buying Reliance shares, so currently Reliance trades at some value. You want to buy it at 2100. You want to buy it at this price, but in the future, you believe 1 month from now, Reliance will go to 2300. So, you want to benefit from this. You want to be able to buy a 2300 worth Reliance at 2100. So, that's the main reason why you are buying an option. Which option? Call option. Okay. You expect the Reliance prices will increase. So, a call buyer is somebody who believes that the market will be bullish. Will be bullish. He believes in a bullish narrative, right? Now, what if Reliance goes to 2400? Will he exercise his call option or will he not? What do you say? Well, the answer is pretty simple. He expects the Reliance would be like trading at 2300, 2300 and something like that. and now the price went to 2400, and he still gets the right to buy Reliance at 2100. So will he exercise his option? Obviously he will exercise his option, because this 2300, which I called as a strike price, is the minimum price at which he or the buyer is going to exercise his option. Strike price, right? It's a minimum. But 1 month from now, so this is like a 1 month leeway period, this is what he expects. This is the expected one, expected price. Now this is the real price, right? 1 month, we are actually fast forwarding 1 month before. Now obviously he's getting 2000 worth, 2400 worth of an asset at 2100. So basically you're buying it at a discount. Obviously that means that the person's bet has been right. It's as simple as that. So he believes in a bullish narrative. He believes that the price of the underlying asset will increase 1 month from now or 2 months from now. It's as simple as that, right? Okay, what if Reliance goes from 2100 to 1900? Now, what did he expect actually? He expected that Reliance share price would actually increase to 2300, and he wanted to buy an option that gives him the right to buy it at the earlier price at which it is trading 1 month before at 2100. But what happened? Bummer. Reliance price drops from 2100 to 1900, right? Now what happens? Now will he exercise his option? Because I told you in the beginning that an option gives you the right but not the obligation. That means you can exercise it or you cannot exercise it. So basically, what happens is, obviously you can't make a bet without putting your money inside it. So when he's betting that the market will go up, obviously somebody is betting that the market will go down or will trade at the same price, right? That person is called as a call seller, and the call seller receives a premium from a call buyer. So call buyer, if I have to basically summarize what is his narrative, he believes in an bullish narrative. And what does he do? He pays premium. He pays premium to whom? To call seller. What does the call seller expect? He believes that the markets will be trading sideways or they can also fall down. So he is somebody who believes in a non-bullish narrative, not bearish. He just believes that he believes in a non-bullish. That means it can trade in the same range or it can go down. So he pays premium. This premium is actually the minimum amount that you have to pay. That means he pays them across, 500 or 600, depending upon the type of stock you're talking about. The premium will be like 2% of the underlying asset or 1%. I don't know exact one, but if you can go and check it out, maybe in the end of the video we'll be doing it. So he pays premium to a call seller. Now let us briefly talk about his profit. If his bet succeeds, then the profit is unlimited, because the price can go from 2300, from 2400 to 2800 to maybe 4000 as well, who knows. So his profit is unlimited. But what about his loss? His loss is limited, because even if it goes to that price, even if it goes to that price, he has to pay a premium, right? He has to pay a premium. So, if his narrative does not match with the reality, then he will be having a loss, and the loss is nothing but it is a limited loss, because this is equal to the total premium paid. Total premium paid. That's all. So, call buyer is someone who believes in a bullish narrative. He pays premium to call sellers, and his profit is unlimited because the price can go anywhere. It can go very high from his expected price, and the loss, if the market goes sideways or it goes down, he's limited because he just has to pay the premium. It's as simple as that, right? You have to have a minimum amount of money for getting into the game, and this premium that you pay, it's not really that high. You're basically saying, so this call seller is trying to believe that the market will go sideways or it is going to go down. That's one of the main reasons why he is selling his call option, and the call buyer is buying it because he believes that the market will be going only upwards. That's as simple as that. His profit is unlimited, his loss is limited. That is equal to the total premium paid. That's as simple as that, right? Now, let us briefly talk about. I will basically summarize the call narrative for you guys. So you have options, and you have call, you have put, and you have a call buyer, and you have a call seller. So a call buyer basically believes in a bullish narrative. He pays premium, and the profit is unlimited. The profit is unlimited, and his loss is limited. Clear? Now, what about a call seller? A call seller is somebody who is not bullish. What? He is not bullish. So he receives the premium. He believes that the market will go trade sideways or it will go down. Whereas a bullish investor, whereas a bullish call buyer, he believes that the market will only go up. So what about him? He receives premium, right? If the market receives premium, and what about his profit? His profit is very simple. The profit is limited, the loss is unlimited. Why? A call seller does not have the right to exercise his contract. That means, for example, see, I am buying from you. You believe that the market will go sideways or down. What I'm saying is, I'm basically gonna pay you a premium because I believe that the market will go up, and I'm paying you a certain fraction of money that is my premium to you, right? And if on the given day the market goes as expected by me, that means I would want to exercise my option. So the seller does not have the right to say no, right? He can't say like, yeah, no, I'm thinking of not selling. See, the price went to 2,400, or now I will be at a loss because I'm gonna have to sell my shares to you at only 2,100. He can't say that, right? That is basically the whole uh, um, mechanism of this options contract. Someone is saying that you need to give me so X amount of shares at that point of time, right? And for each share that I'm going to buy from you at that particular price, I'm giving you a premium. But you are saying, okay, I believe that the market will go sideways or it will go down. So I will happily take the premium from you because I believe that the market will go sideways or down. But if the market goes up and my bet fails, then I'm going to have to sell my shares to you at the price at which we agreed on, which is the strike price or the price at which the market is currently trading at. That means 2,300 also I have to give him at 2,100 only. 2,400 also I have to give him at 2,100 only. So you see why options are very risky. You don't want to be an option seller. It's going to be very hard for you to make money. Right. Now, quickly, let us go to know what is a put option. Right. Let us quickly understand what is a put option. So you have call and you have the put. Now, obviously, even in the put option, you have a put buyer and you also have a put seller. Now, understand the narrative of what a put buyer is. The call buyer believes in a bullish narrative, whereas the put buyer believes in a bearish narrative. That means he believes that the market will go down. That means the sellers will be more when compared to the buyers, and he believes that the market or the underlying asset on which he's betting, he will go down. It's kind of like saying that a put buyer is somebody who believes that Virat Kohli is gonna be out for less than 50. Currently, his batting average is at 50 or 55. He believes that the Virat Kohli average will go down from 55. So he believes that the market will go down. He's completely the opposite of a call buyer. It's as simple as that. So a put buyer is basically bearish, and obviously As he's a buyer, he pays premium, right? What about the profit? The profit is also unlimited, same, similar, unlimited, but the loss is limited again in this case. As simple as that. What about a put seller? A put seller is not bearish. A put seller is not bearish because he believes that the market will be sideways or it will go up. So he receives a premium. He receives premium and his profit again is limited, his loss unlimited. Very simple, guys. So let us quickly have an option. Let us quickly have an example for it. So let us imagine I basically bought a put option. I have been a put buyer. So what is my narrative? Bearish narrative. Bearish narrative. I believe that the market will go down. So currently Reliance traded 2100. Now I believe that the price will go to 1900. This is my strike price. As simple as that, right? So if it goes down, real price, if it goes down to 1800, I'm benefiting because I'm buying. I will be able to sell. See, the put buyer is basically buying the option so that he could sell his stock at 2100 at a price higher than what the market will currently trade at in the future. It's as simple as that. So, call buyer is somebody who wants to have the right to buy his asset at a lower price to the market price. But a put buyer is somebody who wants to have a right, not the obligation, but the right to sell his stocks at 2100 at a higher price related to the trading market price. So he has the right to sell, right? What if the market goes up to 2300? It's the opposite. Then he'll be in a loss. Will he actually um, sell his whole stocks or assets at 2100 when the market is at 2300? No, he would not. So what he will do, he will basically leave his premium. He pays premium. So here in this case, the loss is the total premium paid. Total premium paid. So the premiums that you pay depend upon the total time frame. So you can pay it 1 month later. So this is the 1 month time period. So as you go near the day at which your bet will take place, your premium initially is very big and then it goes on decreasing. It's as simple as that. Okay, his premium generally will decrease as you go forward. So if the price increases, then he will be able to if the price increases, then he's at a loss. If the price decreases, then he will be able to sell his original stock or his original asset at a higher price. It's very simple. So a put seller will have a loss which is unlimited because if it goes to 2100 to maybe say 1700, he has to sell. He has to sell. He is obligated to sell, right? He is obligated to sell his stocks which are at trading at 2100 cost at 1700. It's as simple as that. I hope you guys were able to understand what the different kinds of options. So let us quickly review them. So you have call option and you have put option. You can be a call buyer who believes in a bullish narrative. You will have to pay premium. The profit will be unlimited because the price can go anywhere up. But if it goes sideways or it goes down, you're going to lose your bet and you have to lose your money in the form of premium, but not completely, right? The loss is still very much limited. You're still paying a percentage of the price of each share. Now, what about a call seller? He's not. bullish, he believes that the market will be sideways or it will go down, bearish, and he will receive a premium. And in this case, the profit will be limited, the loss will be unlimited. Because what is the profit? The premium that the call buyer pays. Now, in the case of a put buyer, he is a bearish person. He says he pays the premium to the put seller, and the profit here is unlimited because the price can go down, and he will be able to sell um, his assets at a higher price, and the loss is limited. What about a put seller? He is completely obligated. So buyers are always right, they have the right, not obligation, not obligated, but sellers are always obligated. So the seller has to actually uh, so basically this put buyer will be selling his stock at a higher price, but who will be buying that stock at a higher price? The seller will be buying it because his loss has now gone. So what about a call seller? So basically 2100, it goes to 2300, he's like, hooray, will have to I can have now right have the right to buy the stock at 2100 only when its real price is 2300. I have a $200 profit on each share. Very good. But what about the call seller? He is actually on a loss because now he has to sell his whole stock at 2100 to this guy when the market price is 2300. So his loss is unlimited, guys. But in this case, he will have to buy it at a higher price, right? He sells it at a higher price and he buys it at a higher price. It's as simple as that. Thank you so much. I hope you understand, and feel free to actually share a feedback on the comments if you want. I think that would be really appreciated. Thank you so much.